Russell, let's do a spotlight now on tax law in Kenya and Nigeria. Can you talk us through give us a kind of bird's eye view of some particular issues in these two countries? Now, firstly, in Kenya, I know that in 2023, there was a very big welcome change that everyone was happy about in terms of the VAT Act. Was that basically the zero rating change on exported services?
That's the one I'm thinking of. And I think, as you say, it's a welcome change. The reason we're talking about it is to encourage people not to lose hope that even when countries do some silly things in their tax law, they may be persuadable to change it. The history of Kenya VAT on exported services was it had been zero rated. Then somebody thought it'd be a good idea to make it exempt, which meant you didn't charge VAT, but you couldn't claim any of your input taxes, which were perhaps not such a huge problem for professional services, but for some people it was. And then for 1 year, they decided, no, let's put standard rate VAT on it, which is just a cost increase for the customers. Bear in mind, in most countries, there'd be a reverse charge at the other end. The person buying the service would have his own country VAT on top of it. So this was just making Kenya less competitive. And for a country that sees itself as a hub for the service industry across East Africa and broader, then this was a problem. So taking it back to zero rating was very welcome. It came after a lot of lobbying, but at least it showed the government listened and came to a sensible change. What's a bit of a pity is they ever did the silly thing in the first place.
Yeah, but it is good news that they, we were also involved in some of the lobbying, and finally they listened and brought the change out. So as you say, should never give up hope. Anything else in terms of Kenya? I know the interest-free loans issue has been a long-standing bugbear there. Can you talk us through those rules?
I will, and it always intrigues me because you kind of think, I understand the concept of having withholding tax on interest, and then you have the normal debates of when's it payable, is it on actual cash payment or accrual, those sort of things. So you can understand what they're trying to do. They're saying that the interest has come out of Kenya, it's income in Kenya, we should have some of the tax on it. But you think that if I got an interest-free loan, there should be no withholding tax, because if it's a 10% or 15% withholding tax, 15% of nothing is still nothing. But no, Kenya decides that's not good enough. Let's penalise people. So they would say you lend a foreign company, related party lends money to a company in Kenya, no interest rate. We're going to deem an interest rate and charge you withholding tax on it. So it's done at the official rate, which is perhaps not as bad as it could be. But now you're going to pay the withholding tax. You're not going to get a deduction for the interest because there isn't any.
Yeah.
And then the other country, the lending country, may come around and say, oh, the interest-free loan, well, is that an arm's length rate? We think there should be a transfer pricing adjustment. So now you've got...
So there can be a triple whammy then, where you suffer withholding tax, suffer income tax in the country providing the loan, and suffer withholding tax on a payment that didn't go out.
That's it. And it's all on fictitious income. There's no...
Yeah.
And it's particularly bad if the reason for it being an interest-free loan is because the company borrowing has got no capacity to pay.
Which is very often the issue across for lending into Africa.
Yeah, yes, indeed it is. And it's bad enough having withholding taxes in those cases anyway, but where it's on a made-up number, it's definitely, I think it must have a detrimental effect on lending. And really, these sort of loans, in those cases of a startup or a company that needs supporting, they're not really loans. They're into a form of equity and investment, and shouldn't be having detrimental tax impacts. And it's a damaging investment, I think, and making the cost of a startup more onerous.
Yeah, no, makes sense. Okay, well, let's talk about Nigeria now, and let's start with what should be a very simple question. The Nigerian corporate tax rate. We're always told it's 30%, but I understand it's not really 30% at all.
It's not really. You see this in people's attempts to reconcile their tax rates, effective tax rates. So ignoring the petroleum industry, the headline company income tax rate is 30%. But that's not the end of the story. You have on top of that a tertiary education trust fund tax at currently 3%. It was 2%. It went to 2.5%. Now it's 3%. And bizarrely, it's not on the same base as the income tax. So it's income tax base before you deduct losses brought forward and before you deduct capital allowances. So
wow, that's interesting. So it's an entirely different calculation.
Yep. And you can have a company making a loss or no income tax payable, but suddenly has a
Education tax bill.
education tax. Then you've got things, the thing they here called the NIDTA levy. That's the National Information Technology Development Agency. So that thing is 1% of commercial profits. So that's a different base again, and that has other tax. NESENI, that's I can't remember the entire acronym, but it's for the engineering industry and related. So that's another 1%. And
Wow.
then what's not there is police fund tax, which I don't know why they've passed it. It's some tiny amount, and it's temporary. Hopefully, it sees a sunset soon. But the overall effect is there's a number of additional taxes on top of your mainstream company income tax. And broadly, you can expect that your tax rate's somewhere higher than 33%, because your education tax will be 3% more than your income tax base, and that would be the very least. Now,
Okay, so important to bear this in mind when you're doing your economics on what your corporate tax is expected to be in Nigeria. Don't just go with 30%. It's actually a lot higher.
and it's not just Nigeria. And yeah, I think coming from the UK, we can't be pointing too many fingers about hidden income taxes and sleight of hand with our national insurance contributions. But Ghana's got a thing, a temporary tax. They call it temporary. It replaced the previous temporary tax. It lasted too long. The Growth and Sustainability Levy, I think it's called. And again, it's not insignificant, and adds on to the woes. I'm not really sure why they needed to do it. And we've seen a couple of other countries doing similar things. And don't forget, when you're looking at overall tax rates, the tax bill doesn't end with the company tax bill. Eventually, you're in business because your shareholders want to make a profit. You send the profit back by way of dividend. There's a further tax at that stage, the dividend withholding tax.
Yeah. Yeah. No, that's a good point. Okay, so we know the company tax rate is much higher than 30% in Nigeria. What about the individual tax rate? We know the headline is 24%, but I hear it's actually in practice lower than that.
Yes, it is. I've had lots of debates about this over the years, because if you look at the Income Tax Act, it's quite clear. There's a nice table, and it goes up to 24%. But there's an exemption for a portion of your income. It's a bit of complicated arithmetic required, but when you do it, you find the maximum tax rate you cannot pay higher than is 19.2. And if your income goes above 20 million naira per year, then it reduces to 19%. Now, personally, I'd love to pay 19% compared to what I'm paying in the UK. But
Yeah, that's interesting. I didn't realize the personal tax was so low in Nigeria.
yeah. And then you can plan it even better if you want to have a loan to your company, because then your tax rate on interest income is 10%. So, and there's
Okay.
big arbitrage, as you'll see, arbitrage opening up here now between your company tax rate at about 33% and your income tax rates at about 19, or perhaps even down to 10% on interest. And always felt
So there's good scope if you've got a privately owned business in Nigeria, there's good scope to structure transactions to optimize the tax between the shareholder and the business.
Indeed, there is. Yeah. Yeah.
Great.
Has
Well, thanks.
extra benefit that the individual tax goes to your local state tax authority, whilst the Federation of Nigeria takes the company tax rate. So you get some interesting.
Oh, that's interesting.
Who
Yeah.
do you think can look after your taxes better?
Yeah. Well, that's interesting. Well, thank you for that overview of some interesting tax funnies in Kenya and Nigeria.